The receivable turnover ratios measures the efficiency with which a company is able to collect on its receivables or the credit it extends to customers. The collection period is 365 days divided by annual turnover ratios tell you about how long does it take to collect your receivables. So the collection period measures how many times a company's receivables are converted to cash in a certain period of time. Okay, the receivable turnover ratio is calculated on either an annual or quarterly or on a monthly basis. An efficient company has a higher accounts receivable turnover ratios. Okay, higher the ratio means higher the efficiency. Okay, so the lower the ratio, lower the efficiency. Low turnover ratio indicate that your product or sales are made by receivable than cash. Okay, if the ratios is low, it means that relative to sales you have too much receivables, or relative to receivables you have too low sales. It means that you're making sales most of in receivables, not in cash. Okay, you have sales, but those sales are not made by cash, made by receivables. So you're making a sale but not in cash, you're making receivables. So your accounting numbers show you that you have made some profit, but you don't have cash in your hands. So it means that you're not efficient and there's some kind of risk. Okay. So to put it simply, low turnover ratio indicate that your sales are made by receivable than cash. So if you have too much receivables, too many receivables, there is a risk of not getting it back. Okay, for instance, the receivable turnover ratio of 3, let's say this ratio is 3, it means that one third of sales are made by receivables. If you divide these numbers, if you divide a number of days in a year by annual turnover ratio, it will give you about a 120 days collection period. Okay, since the turnover ratio is derived by dividing the annual sales by the amount of receivables, the ratio of 3 means that 1/3 of the year, say 4 months sales are in receivables. Okay, so 120 days or 4 months of sales are in receivables. Therefore, the collection period comes to 120 days. Okay, inventory turnover relates to inventory to sales or cost of goods sold. Okay, average inventory and cost of goods sold. This inventory turnover is a financial ratio showing how many times the company turned over its inventory relative to its sales or the cost of goods sold, CGS. Okay. Again, how many times a company turned over its inventory relative to its cost of goods sold in a given period. A company can then divide the days in the period, typically a fiscal year, a 365 days, by the inventory turnover ratio to calculate how many days it takes on average to sell its inventory. The inventory turnover ratio can help business make better decisions on pricing, manufacturing, marketing, and purchasing. It is one of the efficiency ratios measuring how effectively a company using its assets. Okay, cost of goods sold is also known as cost of sales. Okay, you may use a cost of goods sold instead of sales in the formula for inventory turnover because inventory is typically calculated at the cost. Okay, in accounting, a balance sheet, your inventory is valued at its cost. Okay, not the current market price, is valued by its cost. Okay. So some companies may use sales in the denominators to inflate these ratios. So when you compare these inventory turnover ratios, you may have to you may look for what ratios are used for the numerators. Okay. So some companies may use sales instead of cost of goods sold in the calculation to increase the resulting ratio. So for instance, since inventory is valued at its cost, the ratio of 2, it means that the firm sold two times more than its inventory. Simply, suppose you're owning a restaurant and you have a total 10 tables. If there was 20 tables in cost of goods sold or in sales, it means you turned over 2 times much as your tables. So that's it. And secondly, the average value of inventory is used to offset seasonality effects. It is calculated by adding the value of inventory at the end of the period to value your inventory at the end of period and dividing the sum by 2. Okay, so inventory at the beginning value plus the ending value divided by 2 will give you the average number. And inventory turnover measures how often a company replaces inventory relative to its sales or cost of goods sales. In general, the higher the ratio, the better. Higher the ratio, the better. Okay. A low inventory turnover might be a sign of weak sales or excessive inventory. Okay. If the ratio is weak, it means that your sales or cost of goods sold, the sales are made by a product sales, a quantity of product sales times current market price, the selling price. The cost of goods sold are quantities for products sold by is a cost. Okay, so these are almost the same concept. So anyway, the lower ratio might be a sign of weak sales. Okay, lower ratios can be derived by lower sales or higher excessive inventory. Okay, also known as a overstocking. So it suggests a problem with a retail chain's merchandising strategy or inadequate marketing. Okay. A high inventory turnover ratio, on the other hand, suggests strong sales, and it could be the result of insufficient inventory. Okay, so there you have to look very carefully. Okay, in general, higher the ratio, better. but higher ratio can be